warahmatullahi wabarakatuh. My name is Anisah Binti Pudzy from ZBA 2423C. A company structure is the specific combination of debt and equity used to fund its overall operations and growth. It also refers to the amount of debt or equity used by a company to fund its operations and assets. The capital structure of a company is typically expressed as a debt to equity or debt to capital ratio. Meanwhile, equity capital is derived from a company's shares as well as claims on its future cash flows and profits. Debt is represented by bonds, issues, or loans, whereas equity is represented by common stock, preferred stock, or retained earnings. Short-term debt is also included in the capital structure. Debt and equity capital are used to fund operations, capital expenditures, acquisitions, and other investments in a business. When deciding whether to use debt or equity to finance operations, firms must make trade-offs, and managers must balance the two to find the optimal capital structure. A company's optimal capital structure refers to the proportion in which its equity and debt are structured. It is intended to strike the ideal balance between increasing the company's wealth and worth and lowering its cost of capital. A company's goal when deciding on its capital structure is to find the lowest weighted average cost of capital, called WACC. The WACC is the weighted average of its equity and debt costs. A company is not required to incur any debt. A company can have an all-equity capital structure or a debt-like structure. It also depends on the industry the company is in, because standard capital structure differ from one industry to the next and whether the company is private or public. To comprehend the optimal capital structure is estimated by calculating the debt-equity mix that minimizes a company's weighted average cost of capital while maximizing its market value. The lower the firm's cost of capital, the higher the present value of future cash flows are discounted by the WACC. Thus, the primary goal of any corporate finance department should be to determine the optimal capital structure that will result in the lowest WACC and the highest company value. According to the economists Franco Montigliani and Martin Miller, in an efficient market, a firm's capital structure does not affect its value in the absence of taxes, progressive costs, agency costs, and asymmetric information. Several empirical studies have been conducted to investigate the determinants of capital structure. Industrial leverage, profitability, firm size, growth opportunities, asset tangibility, expected inflation, and stock market return are among the key factors to be investigated. 1. Financial leverage. Financial leverage or trading on equity is the use of fixed-bearing securities such as debt and preference capital alongside a notch of equity in the capital structure. This is the most important decision in terms of financing. With debt and equity in the capital mix, a company can deploy a certain amount of debt with the intention of reducing the percentage of tax. The benefit will be passed on to the equity shareholders in the form of high dividend percentage. 2. Profitability. A more profitability company will rely less on external debt and will meet its additional needs through internal generation. Profitability is determined by the ROI return on investment or the operating profit ratio. The higher the operating profit ratio, the higher the debt ratio, because the likelihood of not meeting interest costs is low. Third, size of company. Small businesses typically rely on own capital and retained earnings for long-term funding. This is because these companies have difficult time obtaining long-term loans. If they are able to long-term loan, it will be at a very high interest rate and on inconvenient terms. Debt holders, particularly financial institutions, impose numerous restrictions on management's ability to run the business. As a result, long-term loans are neither available nor preferred by small businesses. Fourth, in the early stages, a company's financial needs can be met through long-term sources, particularly by raising equity shares. Once the company receives a positive response and its cash flow capacity is increased through sales, it can raise debt or preference capital to fund its growth and expansion plans. Firms with high market-to-book value ratios have a lot of room to grow. These companies have numerous investment opportunities. However, there is a higher cost of bankruptcy and financial distress if they begin to experience financial difficulties. To avoid financial distress, these companies use lower debt ratios. As a result, growth firms would prefer to take on debt and with a shorter maturity period to keep interest rates low and maintain financial flexibility. When a company or individual is unable to generate sufficient revenue or income to meet or pay its financial obligations, it is said to be in financial distress. This is usually because of high fixed costs, a high percentage of illiquid assets, or revenue that is vulnerable to economic downturns. Poor budgeting, overspending, and excessive debt load, a lawsuit, or the loss of employment can all lead to financial distress. Financial distress is a term that is commonly used in corporate finance to describe any situation in which an individual or company's financial situation causes them to struggle to pay their bills, particularly loan payments due to creditors. Bankruptcy may be the result of severe long-term financial distress. When a financial distress situation arises, it must be addressed immediately for the situation not to worsen. If financial problems are not addressed promptly, they frequently lead to more financial problems. Debt financing is quite common in today's organizational system. Organizations borrow money on a short-term or long-term basis to fund their operations. According to Modigliani and Miller, in the presence of corporate taxes, debt causes a firm's value to increase. On the other hand, financial researchers and experts commonly believe that the cost of bankruptcy could reduce the firm's overall value. According to their point of view and research funding, a firm's value increases when it begins to shift away from equity and toward debt. Now, consider the effect of debt financing. Because of the present value of the minimal distress cost, the probability of distress is low in this situation. As a result, every small increases in debt value raises the present value of this cost. It will eventually equal the increase in tax-shield present value. In this case, bankruptcy will increase rapidly due to the tax shield, resulting in a decrease in funds. From the graph, we can see that as the present value of financial distress cost arises, so does the present value of tax shield on them. If distributions to equity holders are taxed at a lower effective personal tax rate than interest, the corporate tax advantage is partially offset. As a result, we can comprehend how they are intertwined. Pecking order theory is a theory concerning the capital structure of a company in which managers are required to follow a specified hierarchy when choosing the source of finance in the company, where according to the hierarchy, first preference is given to internal financing, then to external sources when enough funds cannot be raised through internal financing, where that issue will be considered first to generate funds, and finally equity if the funds are insufficient. Donaldson proposed deep theory in 1961 and Myers and Maloof modified it in 1984. This theory may not always be the best way to proceed, but it does guide on how to begin financing. As an example, suppose a company needs to raise 100 million to expand its product into new markets. In addition, the company's financial structure is as follows. On their balance sheets, the company has 210 million in net earnings, cash, and other equity. Because of the company's debt rating, the bank agreed to lend it money at an interest rate of 8.5%. The company can raise equity but at 7.5% discount, which means that if the companies issue additional rounds of funding, the company's share price will fall by 7.5%, which is the rate at which the company can raise money. If the company needs to raise funds for the project, it can use a combination of the methods described above. According to the pecking order theory, the cost of funding will rise in ascending order in the example above. Signaling is the act of initiating a trading position using insider information. It occurs when an insider releases critical information about a company, causing people who do not normally have insider information to buy or sell its stock. Outsiders consider these insiders' actions to be a market signal. Market signaling can be obtained by tracking companies' insiders' shareholding and trading positions. Insiders are typically senior executives or large shareholders in the company. They may have decision-making authority and access to internal company information. Technical analysis is frequently used to fuel the signaling approach, with trades initiated and completed by alerts generated from technical studies on price charts. The approach, however, is not limited to technical triggers. Data from other sources such as market sentiment and macroeconomic data can also be used. Traders can use a signaling approach on any type of security or asset as long as they trade with sufficient liquidity and publish prices on other relevant data regularly. Many traders rely on technical indicators such as price charts, and momentum indicators to make trading decisions. Others try to interpret the actions of a company insiders and executives who have access to confidential information about a company's performance.